Hello. In this video, we'll be talking about the various cost allocation methods used in property, plant, and equipment. Let's talk about what cost allocation is briefly. When a company purchases property, plant, and equipment, they expect it to provide future benefits, which means that the asset is capitalized on its balance sheet. So it's recorded as a long-term asset on its balance sheet. The cost of these assets should be allocated to periods that are benefited by their use. And the way we do that is through different cost allocation methods that we will discuss in this video. There's three different cost allocation terms. Depreciation is used for when we allocate the cost for property, plant, and equipment. Depletion is the term we use when we allocate costs for natural resources, and amortization is the term for intangible assets. But they all use the formulas used to calculate the depreciation, depletion, and amortization. The various ones are similar to each of the different types of assets. There are time-based depreciation methods and activity-based depreciation methods. We'll start with the time-based activity methods. The first one and most common is called the straight line method. And the straight line method allocates an equal amount of depreciable base to each year of the asset's useful service life or useful life. And it's the easiest one to understand, and it provides a positive effect on net income in earlier years versus an accelerated method. That's what it means. And when we go to accelerated method, you'll see what we mean. Let's take an example, and we're going to work through the different methods in this video using the same example. At the beginning of year one, Hover Manufacturing Company purchased a machine for $250,000 and made the following estimates at that time. Estimated residual value was $40,000, estimated service life was 5 years, and estimated production was 140,000 units. We're not going to use this in the straight line method, so you can kind of just ignore this piece of information. The formula for straight line method is the cost, so the 250,000 minus the estimated residual value, which the problem tells us is 40,000, divided by the estimated service life, which is 5 years, gives us our depreciation per year. Okay, so this is the depreciation for the full year. Okay, so let's look at this table and see what happens. So our depreciable base is 210,000. So 250 minus 40. That's the amount that we're depreciating times 1/5, which is we're depreciating 1 year over the 5-year total, which is actually the 20%. And that gives us the $42,000. It's just laid out kind of differently in this, it's just a different format. So in year one, our depreciation expense equals our accumulated depreciation, but that's only in year one. This is book value at the end of the year. Your book value is always going to be your cost. It's right here. This is your book value. This is a very important term to know throughout this chapter, and really whenever you're dealing with accounting, you have to know this term book value. And it's cost minus the accumulated depreciation. So the ending book value at the end of year one is 250,000 minus 42 is $208,000. And in straight line, your depreciable base is the same all 5 years for your entire service life. You depreciate it using the same rate every year, which is in this case 20%. So your depreciation expense for the current year is the same each year. As you depreciate your asset year over year, your accumulated depreciation increases by that depreciation expense amount. And it's right here in the term, it's accumulated depreciation. So year one, it's 42,000. Year two, you add 42,000, then you add another 42, et cetera, et cetera. Let's look at year two right here. Our accumulated depreciation now is $84,000 because we have year one depreciation expense of 42,000 and year two. Our book value at the end of year two is going to be our cost, which is 250,000, minus now our accumulated depreciation is 84. So your book value at the end of year two is $166,000. And it's going to decrease by $42,000 each year until, notice at the end of year five, your book value is $40,000, which is equal to your residual value. So you're not depreciating the entire cost, you're depreciating your depreciable base, which is your cost minus your salvage value or residual value. Your journal entry at the end of each of the 5 years would be debit depreciation expense 42,000, credit accumulated depreciation 42,000. The second and third time-based depreciation methods are considered to be accelerated methods. And what that means is that they result in more depreciation in the earlier years of an asset life. And because you have more depreciation, right, more expenses in the earlier year, it's a greater tax benefit because in the earlier years, your taxable income is reduced, which means the tax that you owe on that income is reduced. When we talked about straight line before, the types of assets that get depreciated over a straight line method would be assets that you expect to be utilized in the same manner or the same kind of amount over time. So think of a building or furniture. You know, the way a building or furniture deteriorates is the same over time, pretty similar, versus an accelerated method. You know, think of a car. A car gets, I'll say, used up in the earlier years more so than the late years. When you buy a car, the second you drive it off the lot, it loses value, right? We say it loses its depreciation. It's depreciating in value, I should say. But a car, as time goes on, the car operates not in the same manner as before. So that's the type of asset that usually you can expect to have an accelerated method. So the two accelerated methods are the declining balance method and the sum of the year's digits method. This method is almost rarely used and we're not going to go over in this video. The declining balance method multiplies the beginning of the year book value, here's that term again, by an annual rate that's some sort of a multiple of the straight line rate. And once we go through an example, you'll see what that means. We're going to go through the same example where a machine costing $250,000 was purchased with an estimated residual value of 40 years and the service life of 5 years. Again, this is called double declining balance method because we're going to do times 2, but we're not going to use this estimated production of units information for this method. So here's how you depreciate using the double declining method. You take your book value at the beginning of the year, the full $250,000. Notice this does not subtract out the salvage value or the residual value of $40,000 like it did in the straight line method, okay? That's super important. Your depreciation rate per year is going to be 40%. And here's how we do it. The service life is 5 years, so we take 1 over 5, okay, which equals 20%, and we double it. That's how we get the 40% right here. This particular method we're calling double declining balance method because we are doubling the straight line rate. If we wanted to do 150%, we would take this 20% times 1.5, and that would give us a 30% depreciation rate per year. But right now we're doing double declining, so we're just multiplying by 2, and our depreciation rate per year is 40%. So we take our beginning of the year book value times our depreciation rate, 40%, and year one we have depreciation expense of $100,000. In year one only, our cumulative depreciation equals $100,000. Our book value at the end of the year is the same thing. It's the cost minus your accumulated depreciation is your book value. So we take our cost of $250,000 minus our accumulated depreciation $100,000, and we get book value at the end of the year of $150,000. That book value at the end of the year is now our year two beginning of the year book value, right? That just carries through. We're going to use the same rate of 40%. So we take 150,000 times 40% equals 60,000. Now our accumulated depreciation is going to be this 100,000 plus 60,000. So our accumulated depreciation is 160,000. Our book value at the end of the year is going to be our cost, which is 250,000 minus our accumulated depreciation of 160 to give us a book value at the end of the year of 90,000. We're going to take this 90,000 and we're going to carry it over to year three, the beginning book value, and we're going to go through the exact same exercise on and on. Okay, let's look at year four. Now we're at year four. This is a 5-year asset. Our beginning value, beginning of the year book value is $54,000. If you take $54,000, if you take $54,000 and you multiply by the 40%, it equals to 21.6. Well, what happens if I were to put 21.6 here? Well, let's just see. We would take our accumulated depreciation would be 196 plus 21.6. Oh, 196. Our cumulative depreciation would be 217,600, and our book value at the end of the year would be the 250,000 minus the 217, giving us an end of the year book value of 32,400. Okay, that's if we just took the 54,000 and multiply by 40%, just like we did for the previous years. What do you see here? This 32,400, the end of the year book value, if we were to do that, is less than our residual value, right? They told us that our residual value right here is $40,000. Your book value at the end of the year cannot go less than $40,000. So let's just erase this and see what it should be. We're in year four, we're at beginning of the year. Book value is $54,000, and this $14,000 is the maximum amount of depreciation expense that can be taken such that our ending book value will not go below $40,000. So if we were to look at the year three accumulated depreciation was 196,000, and then we're going to take year four depreciation expense of 14,000, gives us our year four accumulated depreciation of 210,000. Now, our cost minus accumulated depreciation equals our book value. So if we look at year four, our cost is 250,000 minus this right here, this 210,000, gives us a book value of $40,000, which is equal to the residual value. So the $14,000 here is a plug. There's no sort of formula. It's just you have to plug it in to make it work such that your ending book value is $40,000. And then notice in year five, our ending book value from year four is the beginning book value of year five. Year five has zero depreciation expense. We've already fully depreciated this asset. Now, let's just look really quickly at the depreciation expense per year here. And you see the year one, we have 100,000. Year two, 60. then 36, and 14. The depreciation expense declines year over year. This is what we mean by accelerated depreciation. You have more depreciation in the earlier years than you do in the later years, right? In the earlier, you can see it goes the highest in year one, and then it slowly declines. That's what it means by an accelerated depreciation. The last type of depreciation method we're going to talk about is an activity-based depreciation method called units of production method. And in this method, it computes a depreciation rate per measure of activity. And then it multiplies that rate by the actual activity to determine a periodic depreciation. Now, that's a lot of words. It will make more sense when we go through an example. The units of production method, what it does, it provides a better matching of the asset's cost to the related revenues. And really, the units of production, instead of calculating the depreciation based on time, it's based on the asset's output. So think of a factory machine that makes widgets, and the factory machine can make 1,000,000 widgets, over its lifetime, and that's what's going to be used to calculate its depreciation. Or an aircraft engine, if you're depreciating just that separately, well, you just depreciate the actual aircraft. It might be based on flight time rather than years, because really an airplane can fly a certain number of hours, right, before it's done. So same example, except now we're going to use this piece of information where the estimated production is 140,000 units. And the problem tells us in each year how many units are produced. And now it says the estimated production is 140,000 units. Like when we first acquired this asset, we estimated that it can only make 140,000 units. At the end of its life, it made 150. So let's see how that plays out. Units of production calculation formula is very similar to straight line in that you take the cost minus the estimated residual value. But now instead of dividing by the service life, you're going to divide by the estimated units of productivity for that entire life of that asset, which in this case would be 140,000. And then you're going to get like a depreciation rate per unit and multiply by the units produced every year. Let's go through it. So we take our cost minus residual value divided by the 140,000 units that we expected to produce over its lifetime. And so we are going to depreciate this unit $1.50 for each unit it produces. So year one, we're told it produces 20,000 units. We're going to take that times $1.50. And our depreciation expense in year one is 30,000, which in year one equals accumulated depreciation. Book value, again, book value is going to be your cost minus accumulated depreciation equals book value. I know I keep repeating this, but it's a really, really important concept that I think a lot of students in accounting can easily miss. And it just comes up over and over again. So at the end of the year, book value is 250,000 minus our cumulative depreciation of 30 is 220. Year two, right? Now we just look at the units produced in year two, and the problem tells us it's 32,000. Our depreciation rate per unit is $1.50. So our year two depreciation expense is $48,000. And then our accumulated depreciation in year two is going to be our year one plus our year two depreciation. So year two is 78,000, and the book value at the end of year two is going to be your 250,000 minus your accumulated depreciation of 78,000. Let's fast forward to year four. We make 28,000, which gives us depreciation expense of 42,000, and our cumulative depreciation expense is 186. It's these 4 years is going to be 186,000. That's how we get that. And our book value is 64,000, ending book value. Okay. Year five, we make 26,000 units. However, we know that our ending book value needs to be our residual value. Our residual value. So, similar to the double declining method or the accelerated method, this number, the current year depreciation expense number, is a plug. It's whatever is needed to make your ending book value equal to $40,000. Notice that this $1.50 did not carry to year 5 because we didn't use it $1.50. We just plugged it to make it work so that our residual value is our ending book value. Now, this is just a comparison of the different types of depreciation methods. The straight line, double declining, units of production. We didn't go over some of the year's digits, but this is what it would have been. And just to notice that in total, you're going to have $210,000 of depreciation expense. And that was the $250,000 cost minus the $40,000 residual value, right? So that's what we had to get to. Straight line, same number each year. Double declining goes down each year, accelerated in the beginning. We're not even going to talk about some of the year's digits. And the units of production can vary depending on how many units the equipment, the asset produced per year.